The financial markets are officially closed today for the weekend on this Saturday, July 4, 2026, meaning we have a clear window to step back from the frantic ticking of the live charts and look closely at the underlying forces moving the board. When the closing bell rang yesterday afternoon on Friday, July 3, 2026, Nokia stock settled down at $12.02 per share on the New York Stock Exchange. This represented an intraday drop of 69 cents, translating to a single-day decline of roughly 6.62% during Friday's high-volume session. For casual observers tracking ticker movements on a standard retail individual brokerage account, this sharp drop might look like a sign of structural weakness or the structural fading of a temporary rally. But if you peer just under the surface of the regular corporate news, you will find a completely unexpected development that changes the narrative entirely. Major global banking institutions, including Bank of America, have quietly adjusted their targets upward to over €15, driven by a massive surge in underlying demand for specialized optical networking equipment that directly supports hyperscale data systems. While traditional retail investors are focused on classical cell towers, the large-scale institutional players are accumulating positions because they realize Nokia is quietly becoming a backbone supplier for infrastructure that connects advanced computing nodes across the globe. The common ground shared by the vast majority of retail participants looking at investing sites is that Nokia is a relic of the past, a slow-moving utility play tied to the cyclical, capital-intensive rollouts of traditional mobile carrier networks. People look at their portfolios on the Robinhood app or see discussions across common online investment boards and view this company as an uninspiring option compared to high-flying assets like Tesla stock or Apple stock. The prevailing expectation is that Nokia will grind sideways, weighed down by slow corporate spending and tough competition in the telecommunications sector. However, the ground reality is shifting rapidly beneath our feet, presenting a massive contrast to that consensus view. The true narrative driving the massive year-to-date gains, where the equity nearly doubled in value prior to this recent weekly cooling phase, is its quiet capture of massive enterprise orders from the world's largest cloud service providers. The company recently confirmed a staggering €1 billion in initial orders specifically tied to high-speed optical hardware and intelligent packet routing switches designed to prevent networking bottlenecks in major data center clusters. When retail traders log on to their mobile software to execute self-investing plans, they are often chasing the obvious headline makers, completely missing the fact that the architecture holding up those very platforms is being updated by companies like Nokia. When we break down the recent market action, the daily swings tell a story of intense institutional positioning ahead of the crucial second quarter earnings release scheduled for later this month on July 23rd. The high trading volume we witnessed during the recent sessions indicates a heavy rotation of capital. Large institutional funds utilizing high-end execution tools via an interactive brokers platform are absorbing shares on these major dips, while shorter-term retail traders using basic Robinhood fractional shares might be shaking out due to short-term volatility fear. This macro rotation is occurring against a backdrop of complex sector momentum, where classic hardware suppliers are struggling, but anything levered to high-capacity enterprise throughput is seeing immense demand. Look at how NVIDIA stock has drawn massive institutional capital into the foundational silicon hardware space. Now, that immense computing power requires immense data transport speeds to function across massive facility grids, which is where Nokia's high-margin optical transport business enters the frame. The recent drop to $12.02 is a direct reflection of broad macroeconomic pressures, including persistent global interest rate concerns and a general cooling off in speculative tech sectors, rather than an internal failure of the business itself. Understanding how to navigate these specific entry points is where modern online investing tools come into play for the everyday participant. If you are managing your capital through comprehensive suites like Schwab Intelligent Portfolios or using targeted investment help from a dedicated financial planner, the focus is always on identifying mismatches between broad market perception and core balance sheet performance. Investors executing trades via a Fidelity brokerage or monitoring their retirement allocations through Fidelity IRAs are increasingly recognizing that long-term accumulation requires looking past the daily emotional swings of the market. The massive trading volumes we have observed over the past month show that this asset is no longer sitting dormant in the corner of the market. It is experiencing a structural repricing. When people check their daily watch lists on their SoFi trading platform or look at the performance of their broader asset baskets inside specialized Fidelity ETFs, they are beginning to see the telecom sector light up in a way it hasn't done in years. This volume surge suggests that the smart capital is anticipating that the reality of the company's upcoming quarterly numbers will far exceed the cautious expectations currently held by the broader public. Let us pause for a quick moment to get a sense of where everyone in our community stands on this specific asset. Comment below how many shares of Nokia you currently hold in your portfolio right now, and let us know if you are actively buying this dip or waiting for more clarity. To properly contextualize the tension between expectation and reality, we must briefly look at the core business model and the history that shaped the widespread public perception of this entity. For decades, the global collective consciousness associated the brand name with durable mobile handsets, a business that they famously exited long ago. Following that major corporate transition, the organization focused heavily on network infrastructure, spending billions on research and development to compete in the global cellular hardware space. Their primary business model revolves around licensing valuable intellectual property through a massive patent portfolio and selling extensive hardware, such as base stations, antennas, and core routing equipment to major telecom operators worldwide. Older financial reports from past years showed a company that was heavily dependent on the capital expenditure cycles of major mobile service providers. When those providers slowed down their spending on cellular upgrades, Nokia's margins suffered, leading to years of flat growth and a lack of investor enthusiasm on mainstream investing sites. This historical performance created the very expectation that still haunts the stock today, the belief that it is an old-world industrial supplier incapable of capturing high-margin tech growth. But the reality of the modern corporation is that it has quietly built an enterprise network infrastructure division that bypasses the traditional telecom carriers entirely. This division sells directly to hyperscalers, the massive tech corporations that build out enormous server facilities to power modern applications. By providing advanced optical networking gear that allows these facilities to transfer petabytes of information in milliseconds, the firm has attached its revenue stream to the fastest-growing segment of global technology spending. When you analyze the underlying mechanics of self-investing via modern platforms like SoFi Invest or look through the diverse holdings of Fidelity mutual funds, you begin to see how valuable this diversified business model is. It protects the organization from the cyclical downturns of the traditional mobile carrier market while opening up a high-margin growth avenue. The market is slowly realizing that the legacy label no longer fits, yet the stock is still valued at a significant discount compared to pure-play data center equipment providers. This structural disconnect is exactly what creates the current opportunity for participants looking to build long-term positions through an individual brokerage account. Looking forward into the coming months, there are several distinct scenarios and catalysts that could rapidly shift the price action. The absolute primary catalyst is the upcoming second quarter earnings release on July 23, 2026. The market expects decent numbers, but the true test of reality will be the specific language surrounding enterprise order backlogs. If the management team confirms that their high-margin switch and optical transport wins are accelerating beyond the 18 to 20% growth rate currently projected for the fiscal year, we could see a massive upward repricing. Analysts utilizing professional interactive brokers trading tools are watching the margin expansion closely. If the network infrastructure operating margin climbs toward the upper target of 16%, it will prove that the company is shifting from a low-margin hardware provider to a high-value system supplier. Conversely, the risks are real and cannot be ignored. A broader macroeconomic slowdown that forces large tech companies to delay their infrastructure build-outs would hurt order momentum, and continued competitive pricing pressure from international rivals could crimp margins. Furthermore, the overall liquidity environment will play a major role in how this asset performs. When retail participants manage their day-to-day accounts on the Robinhood app or check their balances through the Fidelity mobile app, their willingness to hold through volatility depends heavily on broad market sentiment. If macroeconomic pressures ease, we